Originally, I was headed toward political philosophy as a professor, and I quit in the middle of a PhD program. But for my master's degree, I wrote a paper I created a term called anarcho-capitalism. At least I did about the same time as a friend of mine did, Murray Rothbard, who is deceased now. He's in effect, the intellectual head of what is now anarcho-capitalism. He was an older man then. I was in my 20s. He was in his 40s or 50s. And I interviewed him for a newspaper I had. We now have a president down in Argentina who's self-declared not libertarian, but anarcho-capitalist, meaning I want to dismantle this thing ultimately. So it's actually taken hold. But the term, Rothbard wrote an essay on it, but I wrote this thing, and I corresponded with him. And I've got the letters, and he praised it and said, "You'll be the first one to have written on this subject." That's good. This back in 71, long time ago. God, I was in my early 20s. Anyway, it's now on Amazon. It's the most popular book under paperback libertarianism. So I'm getting rich. I can only buy beer off the rewards. Anyway, but it's an intellectual defense of the concept based upon emerging of Ayn Rand's minus her politics. Her politics was simply basically what you call founding fathers' limited government notion. Okay, like a conservative, more or less traditional in that regard. I removed that and replaced it with Rothbard's, who's an economist, economics and his politics, which was, we don't need the state. Okay, not that you're going to go overthrow it or anything like that. It'll evolve away over time. Because if it's a bad idea, the concept of monopoly control from above, then it's dysfunctional. Ultimately, its dysfunction will reveal itself this way, that way. Sometimes it takes decades. So far, it's been going on quite a long time. And it doesn't seem to really get better. Just like the government debt ratio doesn't seem to get better, no matter which party wins. Anyway, so I'm not focused on that. I'm not involved in the movement or anything like that decades ago. And it's interesting to see probably something like that is happening, where at least some doubt is sweeping the earth in a lot of places, not just the U.S., about, this institution isn't quite functional. It doesn't seem to ever do what it says it'll do. It always seems to hurt me in some way. And I think a lot of what Trump has promised is simply not going to happen. I think one thing that's going to blow up in his face is he's going to have commodity price inflation big time, whether he wants it or not. And then that some people will look at that and say, well, gosh, I voted for you thinking you're going to keep this down. Anyway, and a lot of other things. Tariffs are nothing but taxes, for example. So he's against taxes in this regard, but he's for them. Anyway, I'm not involved. Yeah, it's as far as what government does or doesn't do, that pretty much doesn't matter. There's a reality bigger than that, okay? And a lot of people think markets go down because something happens. Most markets, when they go down, have big bear trends. It's because of what already happened, built up over years. And the market is expunging itself of that error, overpricing error, assumptions that were false errors. And we've had the biggest bull market in U.S. stock market history from 2009 to 2025. And it was led by the tech area. NASDAQ 100 went up 18-fold in 15 years. S&P went up about 8 or 9-fold. So clearly NASDAQ 100 tech sector was leader. But you say, well, that's a good, strong economy. Well, of course, Trump would admit that because most of the presidents during that time were Democrats. So you look at an M2 chart, Federal Reserve money supply. It's vertical, okay? And basically any 10-year period you pick going back to the 1950s, the money supply went up 90-some-odd%, almost doubled in quantity. Okay, that means given the greater quantity, it has less real buying power. And sure enough, since I was a kid and a loaf of bread was 20 cents, is it because we have a wheat drought? No, it's because of the ongoing degradation in the real value of the money units, not just dollar, but euro, yen, you name it. So that's a major factor. And these things are in play. So as far as the economy goes, I think we're at one of those points now where the bubble is starting to break, stock market. We gave a sell signal for the S&P in early January. That was just short of a high it made in February, and then it dropped hard into April. We know that in any trend, there are counter-trend rallies. But when it was on its way down to 4,800 price level, which was our target for a bounce, not a bottom, a bounce. The bounce has been bigger than we thought it might be because it went up and made a new high. But that was a level where we thought there would be support, and lo and behold, the crowds came in. We point back in our reports recently that we've been around since 1992. But in 2000 dot-com top, MSA called the top in January. It was a sharp drop, and it came back up in March. And it labored all year, comfy, either side of our get-out point. Finally, in 2001, it started to cave. In 2002, collapsed. In fact, the NASDAQ went down 82%, a near wipeout. Okay. Then 2007, another arduous top. Close of 2006, the S&P was about 1350 in price. We projected that we'd go higher in next year into 2007, and we had a target for a top. We defined it as 1550 to 1600. Now, I'm throwing out numbers here. Let me tell you what those are. 1550 was the old high that the market had made in the year 2000. So it was at 1350. We said, we're going to go back to the old high. We're going to take it out. And that's where you're going to top. Well, in May, we went up over 1550 by about 2-3 points, matching the high in 2000. And they sold it. Sharp sell-off into the summer of 2000. This is all during the building mortgage crisis that was increasing in its lethality. Okay. Not recognized by the Federal Reserve, but nevertheless, it was going to happen. Then in September, the Fed cut rates. September 2007, right in the middle of the month. This is a surprise rate cut, 0.5 point. Even though Bernanke back then said, no problem with the mortgage market, it's under control. Well, why'd you cut rates then? Okay. Market went up into October, stopped at 1576. Precisely in the middle of our target zone. That was it. Next 2 years was hell. Okay. Time consuming and teasing. Often with, even once momentum breaks, prices, no, I'm going to go for more. It doesn't, but it makes that new high. I think that's exactly what we're doing now in the U.S. market, is we've teased out the high of early this year. And by the way, if you look through the market more carefully, not just the S&P or the NASDAQ, many sectors, many key symbols, including the Mag 7, aren't making new highs. A couple of the Mag 7 are, but most of them are way off the highs now. So the leadership has been decimated. And it's not exactly what the S&P and the NASDAQ charts seem to be saying. We think it's a top. It's important for silver and gold. Because when that money flows out of there, and it's already begun to, seeking an alternative place, monetary metals will be the prime area. Gold is already reflecting that, and we think that silver is about to take control and vastly outperform gold. And probably much of that you're going to see in the next 5 to 6 months. Because quite often price is teasing, meaning it might do something that looks like a breakout, but it's not. It's a coin toss. And a lot of people say, oh, that's a breakout. Well, if you look at the NASDAQ 100 or S&P over the last year or so, year or two, you've made a high, the recent one. You made a low in April. You made a lower high back in January, which you've now exceeded. You made a low in August of 24. But you've got this, what the Edwards and McGee, this is an old classic book on technical analysis of stock market trends, it's called, written in the 1950s. It's about 400 pages thick and fine print. And I bought it in 1975 when I was with E.F. Hutton, the future side of the market, and to learn about technical analysis. It's just price chart stuff now. MSA is beyond that. But right now, momentum says, you're broken. Price says, hey, I just made a new high. But it happens to be a price topping pattern that Edwards and McGee defined decades ago called the broadening pattern, broadening top, where you make a high at number 5, you make a low at 4, 3, 2. It's widening. But you've got 3 distinct highs, each higher. It's a broadening pattern. And so every time it makes a new high, you think it's going to launch, and it doesn't. Once you get to that third high, which we're now at and starting to roll over a little bit today, that is your final high. And we've got some metrics on momentum that will tell us, yep, that was the final high. So we think when that market breaks, it will be a glacial mover. One, it will panic the central bank because the data points will follow the market down. It will irritate the hell out of the president, and he'll be banging on Powell's head. But it will change a lot of things. It will cause money flow. And when money flows out of the stock market, it's traditionally moved into 2 places: treasury bonds and gold, and related to gold, silver, for example. This was true in 2000, 2002, 2007 to 2009. And it's been true lately. You'll see gold has gone up. Well, the stock market has done this broadening pattern. Once you punch the hole in the stock market to where people start to realize it is broken, that money will flow even more aggressively. But the problem is T-bonds aren't behaving this time. T-bonds are a problem also for the government. Their own debt, not private debt, their own debt. They got a noose around their neck. So we were left with really monetary metals as the only viable alternative. And I think at this point, we're about to launch a more aggressive upside between now and the end of the year. But I think silver and gold and silver miners will vastly beat gold in the next 6 months in terms of percent gain. ran up last year in 2024, early in that year in March. We put out a major renewed buy signal on gold and silver and the miners. Renewed meaning that for prior couple of years, they've been in pause mode. Silver and the miners had been staircasing down in corrective mode. Gold was going sideways, basically, capped at around 2,000. We said back in March of a year ago that we're going to take off again. And sure enough, they did. Okay. Silver actually at one point in that rally outpaced gold pretty nicely, but it didn't last, okay, in terms of relative performance. Silver ran up in May of 2024, in other words, a handful of months after our signal, and got up it was, at our time of our signal, it was $25, $26. It got up to $32.70 a year ago in May, okay, and dropped from there. Came up later in October, got to $35, new high. Gold was going sideways during the time. Dropped again, went back up in March of this year again to 35. And that's when they had that panic sell-off into April, where investors wrongly thought that if the stock market goes down, silver must go with it. Gold didn't drop much during that time, but silver was punished severely. We know that. It went from 35 to 27.50, much of that in 2.5 days. Then it exploded right back over 30 and has worked its way up. Now we're 37, either side of 37 for the last several weeks. That process in price, where we basically, you could draw a line sideways from May of last year through a month ago. We've been above it and below it, but basically just violent oscillations. So it was really sideways. That was a corrective pause in price. And for momentum, our long-term momentum, it had a corrective pullback, where on the momentum chart, you could see a tube, where momentum readings just kept zigzagging with downside in this very clear technical tube, parallel channel. In June, early in last month, we crossed up through that momentum channel. Price wasn't making a new high. Wasn't back above the 35 level. But in the 34s, momentum said, I'm out of here. Boom. Got up to 37 now recently. So it's broken out. That is the beginning of what I think is likely to be a couple quarter long, 5 or so months of upside, and likely to be very aggressive. Similar behavior occurred back in 1979, when silver exploded to 50. Also in 2010, the $25 to $30 level, before silver exploded to 50 again. We argue this time, this breakout will render highly likely another aggressive move, but one that will not pause at 50. We think this one is going to get its first pause in the 60 to 70 zone, well above the old idiot highs. I call them idiot highs because really you didn't spend any time up there. It was like phantom. It was like a day or two. Thin air. I think by going through 50, which is not technically important for us, but it is for anybody looking at a stupid price chart, it's all-time new high. In real dollar terms, if silver were to match those $50 highs, it'd probably be $300 an ounce in real dollar terms, underlying decay of the money in it. But I think that's likely to occur in the next 5 to 6 months, that phase of it. That is not the end of the bull. That's just the next thunderbolt. And during that time, I think silver will basically double in relative performance to what gold does during that time. Silver is definitely going to be the better place to be.